Hello. We're going to start with chapter 4 today. And in this chapter, we are going to look at a homework problem, which is problem 4-3A. This is a rather large problem, but it's a comprehensive problem in that we can discuss a lot of things that have been covered in chapters 3 and 4. So in this problem, we are told that we started a business on May 1st, 2017. They've given us the transactions that have happened they've given us a trial balance after all the transactions happened in the month of May. The unadjusted trial balance shows us the following accounts. In the problem, they've asked us to do various things. The first of which is to prepare the adjusting entries. So let's address the adjusting entries first before we proceed with the rest of the problem. Okay. So the first one they tell us is insurance expires at the rate of $450 per month. So let's look back at our trial balance and we'll look at insurance over here. Prepaid insurance was $1,800. Of this $450 of insurance, we got the benefit out of it during the month of May. Therefore, that has to be expensed. We will debit the account insurance expense. To the extent we got the benefit, it's no longer an asset. We need to decrease this account. So assets are credited in order to decrease them. So prepaid insurance will be credited. And the amount we already know is $450. The next information we've been given is a count of supplies shows we have $1,050 of unused supplies on May 31st. This is another way of saying supplies on hand is $1,050. Again, when we look back at our trial balance, we had supplies of $2,600 when we started the month. At the end of the month, we have $1,050 worth of supplies. The difference is what was used. Again, what's used becomes an expense. So we'll debit supplies expense. And what is used is no longer with us. So I have to credit the asset in order to decrease it. And we're going to do this for the difference. That is 2,600 minus 1,050. So 1,550 is the amount that was used, and that becomes depreciation. The third piece of information we've been given is about our assets, building, and equipment. We are told that the annual depreciation is going to be $3,600 for building and $3,000 for equipment. The journal entry is depreciation expense debit and accumulated depreciation credit. Now we can combine this into one journal entry, or we can keep this as two separate journal entries. If I kept it as two journal entries, it would be depreciation expense debit, accumulated depreciation building credit, depreciation expense debit, accumulated depreciation equipment credit. I think on Wiley Plus, that's how you're asked to do it. I'm combining it over here. For building, it's $3,600 for the year. So how much is it for the month of May? I'm just doing my adjusting entries for 1 month. It's going to be 3,600 divided by 12, which gives me 300. For equipment, it's $3,000 per year. So again, $3,000 divided by 12 gives me 250. Since I'm doing just one combined entry, I add up these two amounts and I say depreciation expense debit, accumulated depreciation for building, and accumulated depreciation for equipment credit. These accounts, accumulated depreciation, are contra asset accounts. It means these accounts exist with the sole purpose of decreasing these respective asset accounts. We take care of those in the balance sheet. Building and equipment are assets, they go into the balance sheet. Therefore, these two also will go into the balance sheet. Building and equipment as assets have debit balances. These two as contra accounts will have credit balances. Let's move on to the fourth piece of information. The mortgage interest rate is 6%. Anytime you've been given a rate, it's always per annum, which means per year. The mortgage was taken out on May 1st. We will have to accrue interest only for 1 month, for the month of May. Our journal entry is going to be interest expense debit, interest payable credit. The amount is going to be, the mortgage payable was $36,000, so it's going to be $36,000 times 6% divided by 12 because it's only for 1 month. So $36,000 times 6% divided by 12. And you'll notice I wrote interest payable credit, not mortgage payable. We keep those as two separate accounts because this interest has to be paid up immediately. The fifth piece of information we've been given is unearned rent of $2,500 has been earned. Unearned rent is a liability. If you look at your balance sheet, we have $3,300 in unearned rent. What this basically means is my customers have paid me ahead of time. I still owe them the service of letting them use my hotel. Of the $3,300, $2,500 has been earned, which means it's no longer a liability. A liability has a credit balance. In order to decrease the liability, I will debit the liability, unearned rent, and now I can call it revenues. So I'll credit rent revenue. And we were given that amount, $2,500. We didn't have to calculate it. The last piece of information is relatively easy. Salaries of $900 are accrued and unpaid at May 31st. What this means is my employees have done the work for me. I got the benefit from their work. I owe them $900. I didn't pay it on May 31st. Probably the very next day I'm going to make the payment or within a couple of days. So my journal entry is going to be salaries and wages expense debit and salaries and wages payable credit. Again, I was given the amount and this $900. So we've done our 6 adjusting entries at the end of the month. What's the next step? I'm going to move things over a little here. The next step is to transfer all this information into our T accounts, into the ledger. What you will see is I have taken the information that was given from the unadjusted trial balance. I'd already put that information in over here in all my T accounts. Now I'll transfer the information. I'll post the information from the adjusting entries into the ledgers, and then I'll update the balances, which basically means I'll recalculate what the balance is. So let me go through one or two with you before I show you how it's going to work out. Insurance expense debit, prepaid insurance credit. If you notice, I did not have an insurance expense account in the trial balance over here. I opened a new account. So I'll put insurance expense debit and prepaid insurance credit. The next one, supplies expense debit, supplies credit. Same thing, I didn't have supplies expense. I open a T account, but I did have supplies, so I put that on the credit side. So I will do that for all the adjusting entries. Bring the information over here, and then we find the balances. Now I just want to make sure that we all remember that in the adjusting entries, cash should never be debited or credited. So that number should remain unchanged. There are 2 exceptions to the rule. One would be when we do bank reconciliation at the end of the month, if there are any adjustments to cash, we will do that. That does tend to happen. So that exception tends to happen. The other exception, which should be very rare, is if you're doing an error correction. Otherwise, typically when you're going through these adjusting entries, I do not ever want you to see you make this mistake of debiting or crediting cash. So that number, whatever you had in your unadjusted trial balance, it will stay the same in the adjusted trial balance when we get ready to prepare that. So now I'm going to go ahead and just show you all the numbers that were posted here and what their balances are, the updated balances. So supplies 2,600, we already had a debit balance. I credited supplies 1,550, bringing it down to the desired balance of 1,050. Did the same for all the accounts. I'm now ready to do the next step. And what's the next step? Preparing the adjusted trial balance. The adjusted trial balance essentially is the same as the trial balance with all the new updated balances. So I'll go through the process of identifying all the accounts that are there. Okay, so I'll bring in all the accounts. Of course, they have to be non-zero balance, otherwise I don't bother bringing them over. And whatever their balances are, I bring those over. And again, the rule holds that our total debits must equal to total credits. Okay. Once I have my adjusted trial balance ready, I'm now ready to prepare my three financial statements: the income statement, statement of retained earnings, and the balance sheet. Now, the balance sheet, I have a classified balance sheet where I have current assets, long-term assets, current liabilities, long-term liabilities. I have these listed over here. What we also know is in our stockholders' equity section, there should be only two accounts: common stock and retained earnings, nothing else over there. Okay, what else do we know before we proceed? We know how to prepare our statement of retained earnings. Retained earnings beginning balance, add the net income, we calculate a subtotal, we subtract dividends, and then we have retained earnings ending balance. You'll notice in this particular problem, we didn't have any dividends, we didn't issue dividends, so you could skip that if you wanted to. That is, you'd have retained earnings beginning balance, add net income, and then you could just have retained earnings ending balance. That would be fine. But I'm going to leave this up here so that you get used to the idea that this is a standard formula. Retained earnings beginning balance, add net income, gives you the subtotal, less dividends paid, if any, gives us the retained earnings ending balance. Okay, so let's come to our income statement. In our income statement, we have revenues. And if you look at your trial balance, the adjusted trial balance, there's only one revenue item over here. Makes life a little easy. I have only one revenue item. I put that in the inside column just for consistency, and you'll see that in a minute why it kind of looks a little better visually. And I have total revenues of $11,500. What do we list after that? After that, we list our expenses. And obviously, we have a whole bunch of expenses over here. I will list each one of them individually. And that's why I said visually it's better if I have total revenues in the outside column, total expense in the outside column, and the details in the inside column. Once again, in this particular problem, since there was only one revenue, if you had put that amount in the outside column, would not be incorrect, but visually this is a little better. The difference between total revenues and total expenses gives us a net income, and that number is $3,570 in this problem. Next, we move to the statement of retained earnings. Retained earnings beginning balance does not appear anywhere in our, it was not there in the trial balance, nor was it in the unadjusted or the adjusted trial balance. The reason is because, if you go back over here, we started our business on May 1st. So obviously there is nothing from a prior period. Everything we have is from now. So retained earnings beginning balance will be 0. The net income we'll bring from the previous statement, scroll up a little, is $3,570. So what I have is $3,570. And as I already told you, in this particular problem, we did not pay out any dividends. So my ending balance is $3,550. Essentially, the current year's net income is our retained earnings ending balance. So again, over here, I'm going to bring that number forward. I need to adjust my screen a little. Okay. The next we're going to look at is a balance sheet. In the balance sheet, all assets have to be listed, but I'm going to classify them as current and long-term. So when we go through our asset accounts over here, and I'll highlight them for you in a second. The asset accounts we have are cash, supplies, prepaid insurance, land, building, and equipment. We also have these two contra asset accounts that we need to take care of that need to be accounted for over here. So let's review these over here for a second. Current assets are those assets that will convert into cash, or we will get the benefit from it within the next 1 year or the operating cycle, whichever is longer. So cash is already in the most liquid form. Supplies, we typically expect to use it up within a short period of time, that's next year. Prepaid insurance, we told, was a 1-year insurance policy. So again, this one is going to be a current asset. Land, well, hopefully land stays with us forever. Building, definitely beyond 1 year. Equipment is also beyond 1 year. So these three assets are your long-term assets. So they'll be listed under long-term assets, which means the contra assets will also be listed over here. So let me show you my current assets first. I have cash, supplies, prepaid insurance in the inside column, giving me total current assets of 4,900 in the outside column. Long-term assets, I have land, 15,000, building, 70,000. Immediately after that, I will write less accumulated depreciation on building, 300. Okay. Then I have accumulated depreciation equipment, and then accumulated depreciation on equipment. Okay. What would have been better, and I'm going to do this over here. Just bear with me for a second. I'm going to move these numbers into yet another inside column here. What would be a better presentation would be the subtotal for building, and that's referred to as buildings net or net buildings. The same thing would be for equipment. Doesn't change the totals. Totals are what they are. Okay. It's just a matter of how I laid out the presentation that we're going to see. It's a little different over here. So in fact, I have 3 columns, not just 2 columns, in order to account for all the details that I have. So my total current assets are 4,900. Total long-term assets are 101,250, giving me a total of 106,150. Let's continue and look at our liabilities. Again, liabilities are going to be classified as current and long-term. And again, it's a timing issue. Liabilities are legal obligations I have that typically are fulfilled by way of paying cash or providing goods or services. If that's going to happen within the next 1 year or the operating cycle, whichever is longer, we classify it as a current liability. If it's beyond 1 year, we'll put it as a long-term liability. So let me look at my liabilities over here. I have 3 liabilities. I have accounts payable, unearned rent revenue, and mortgage payable. Also, if you look further down here, I have 2 more liabilities that I created in the process of adjusting entries: interest payable and salaries and wages payable. Which of these are going to be due within the next 1 year? Accounts payable typically are monies owed to vendors. Usual terms are 30 to 90 days. So that's going to be a current liability. Unearned rent revenue. Typically, you have to fulfill your obligation within the next 30 days to a year, typically, to your customers. So that's also going to be current. Mortgage payable technically is a long-term liability. But when you get to your intermediate accounting class, you will see a portion of the mortgage payable is reclassified as current every year, the amount that is owed next year. The remaining portion is all kept as long-term. For our purposes, we're going to keep all of it as long-term. Interest payable has to be paid very soon, so it's a current liability. Salaries and wages payable, most certainly it's a current liability. Your employees are not going to work for you if you say you're going to pay them a year or two down the road. You have to pay them within a few days, usually 2 weeks to a month, and that amount has to be paid. Okay, so now that we know that, let's bring that information in over here and see our current liabilities. Oops. Accounts payable, unearned rent revenue, interest payable, salaries and wages payable are all current liabilities. And our long-term liabilities is mortgage payable. There was only one. Mortgage payable is the only long-term liability we have. Okay. And the only other item we have not brought forth from our trial balance is the common stock. We bring that number over. We calculate the total equity. And the last step is adding up these two numbers. I'm going to highlight them again for us so we can see it. Your total liabilities plus total stockholders' equity. When you add up those two numbers, what should that be equal to? This number has to be equal to this number. Total assets must be equal to total liabilities plus stockholders' equity. That's the basic accounting equation. So now that we've prepared our three financial statements, we are done with the month of May. The next thing the problem asks us and what we need to think about in the accounting cycle is, which of these accounts are going to carry over into the next period? In this case, it's going to be into the month of June. And which of these should be closed? They should have a zero balance on June 1st. Let's think about this for a minute. Will my assets stay with me? Will cash stay with me in the month of June? Yes, I take this over. Supplies? Yeah, I take that over too. All my assets are going to stay with me. Liabilities, I already told you, you have to pay those liabilities. They're going to stay with you. Whether it's current or long-term doesn't matter. The only way it's going to go away is if you pay it. Stockholders' equity, that's going to stay with us. So all your balance sheet accounts are going to stay with you. Statement of retained earnings, we don't have dividends in this case, but if we had dividends, that doesn't carry over into the next period. That one is going to be gone at the end of this current period. What do we mean by it's going to be gone? It has to be closed out. All your accounts over here, they all have to be closed out. All your revenues, all your expenses, and dividends accounts have to be closed out. Okay, so the last part of the problem asks, identify which accounts should be closed on May 31st. The answer is all your revenue accounts and all your expense accounts. In this problem, we didn't have dividends, therefore we are not going to talk about it. But if you did have dividends, that also needs to be closed. Those accounts are called temporary or normal accounts, and these are all closed at the end of the period. So the ones that are not closed, which is your assets, liabilities, and the equity accounts of common stock and retained earnings, those are referred to as permanent or real accounts. And these are not closed at the end of each period. Okay, so I hope this has served as a good review of Chapter 4. The transactions during a period result in finally in the unadjusted trial balance. After you do your adjusting entries and update all your T accounts, you prepare your adjusted trial balance. From the adjusted trial balance, you prepare your three financial statements: income statement, statement of retained earnings, and the balance sheet. And after that, you will do a set of journal entries called the closing entries. And as we just discussed, we close all the temporary accounts, which again, just to go over, are all your revenue accounts, all expense accounts, and dividend accounts. All of these are closed at the end of a period. Your permanent or real accounts are not closed. They are what will become the beginning balance for the next period. If you do your closing entry and you again update all your T accounts and prepare a new trial balance, that's referred to as the post-closing trial balance. And in a post-closing trial balance, you should have only permanent accounts, which is assets, liabilities, common stock, and retained earnings. I hope this serves as a good review for your exam, which should be coming up in a few days.